Remember, one of the motivations for being here is unpredictability. Well, here's one thing that the charts show us is a regular and repeating event. They do seem to have a regularity about moving faster at times. That this will happen is predictable. We will look more at that, but we have to see something else about the terminal we use all the time. I've switched from a 30-minute with a 100 MA to a 1 hour with a 50 MA. They're virtually identical, aren't they? Now both together at the same time, and we can really see that there is an ability to relate to price moving slower or faster on either one in the exact same way. There's an equivalency here. 100 on 30-minute or 50 on 60-minute. And we've analyzed price over time. That's how the chart is plotted, and that is also no coincidence the definition of speed. How far price moves in how much time. Still in the kindergarten here, I know, but did we again gloss over something? This equivalence at which we are staring shows us something about charts as they relate to the speed thing. Both charts, using different time frames, are being used to display the exact same analysis. It's a comparative analysis, in this case, of how there are two general price speeds in this area, but it represents all comparatives. The point here brings us so very close to the reason TA is riddled with failure. It is multifaceted, but it's all so interrelated it becomes the singular reason in the end. If you can use two different time frames to display the same analysis by varying the setting of the indicator, then you prove three things. First, you've proven that the time frame is not the only chart control at your disposal to judge speed or other comparative. Second, you have proven that the setting of the indicator is the other chart control. And third, don't worry if it gets a bit more technical here, you have proven that as soon as you place an indicator on your chart, you've declared a speed of analysis. Remember, we are always comparing. This speed of analysis exists due to a choice of time frame and indicator period setting along with or placed on an existing price time movement to which it becomes compared. Let's see what that means. We've loaded our 4 MAs again, same settings as before, onto a 1 hour chart spanning about 2 weeks. In this case, you now have declared 4 speeds of analysis. These are compared to price movement in time. Which one is correct? The relevant one. There are areas where one MA seems to support the uptrend and other areas relate to a different MA. You see a similar effect on this daily chart, which spans about 1 year here. But there's no way to say which MA is most relevant to the speed of the price move, as each speed of analysis seems relevant only for a time. We varied the time frame but kept the indicator static. Now we did just learn that there's a way to vary the indicator settings as another chart control. Perhaps that would help. Help do what? You say, well, I thought we were trying to see about making the analysis relevant to the speed of the movement. Well, okay, but this was just a way for me to get you to reach your own conclusion, that a rigid analysis cannot match the speed of the movement if the speed is changing, and especially since even different areas seem to be variable as to just how much pedal to the metal there is. It was crucially important for you to reach your own conclusion that all your methods, indicators, systems, and trade robots use this rigid approach. It is quite obvious that they will not be able to distinguish the difference in speeds between the strong trend we saw on the left and this toilet flush on the right. There's nothing wrong with using tools, indicators, and automation. I never met an indicator I didn't like. The tricky thing here is that the indicator's whole task is to be rigid, so there is a comparison to what is moving and changing. Consider a radar gun performing the same task as the indicator in comparing to a moving object. You know the police cannot take the radar gun to a completely different speed zone without changing the calibration to match the local speed limit, or the violation triple alarm will not be sounding at the right time. That is what is happening with your TA approach. With your own eyes, you see that there are speed changes in the price action. Different speed zones hiding in plain sight on every chart you've ever seen. And nobody likes a speed trap. Technical analysis today does not mention speed changes. A search on the internet will get you some info about speed lines, a complete misnomer for a fan-style retracement tool, and momentum, rate of change. This is not helpful because both suffer from the vulnerability of all indicators, of being uncalibrated for the change in speed that will come as they are applied across different areas. This information does not address what you can already detect with your eyes. This is not really useful information about speed changes. TA is dumb and blind to and ignorant of speed changes since it doesn't define them or tell you how to handle them. Yet, they affect every aspect of the application of all technical approaches. Got a slick, new, fancy, color-themed trading and charting platform for us traders? Does it include hundreds of technical studies? So what? It is 400 years old. Robot with a killer name? Yawn. Some new duds are in order, all right, but 21st century. Something that is evolved and actually matches what the market does. Now to something else the market does with regularity. This is a 1-hour chart with 2 zigzag indicators, and both have different settings, so each will be sensitive to different speeds. What they show us is how the market breaks its movements into 2 parts. This is a constant byproduct of wave action and the conviction brought on in market participants by the appearance of a confirmed move. The second part comes after an initial move was tested by a correction, but it didn't kill the move, and it keeps going. I call these double moves, and they are just about everywhere. They even have double moves inside double moves. If you look close, you'll see there could be even more inside these if there was another even more sensitive zigzag placed on here. Notice that at times both indicators interpret the speed the same way. There are also double moves that are missed by these settings. The market is quite variable. Now that's good because that shows that there's multiple trends simultaneously that you can use for trading at different terms, whatever you like, if you can match up to the speed. And let's just look over a couple more of these. There's a one on the white level right there, and there's double moves inside there. Then there's another double move. If you break it, if we had a slower setting, we'd probably find that this entire thing here that's a double move with a double move inside that is just the second half of a larger double move back up in there. So as you can see, they're everywhere and they're quite variable. So, but this regular trait can be used. It is actually speed changes viewed with a different tool, but no matter, because it is a useful constantly repeating trait. Now, 21st century TA must evolve so that it takes notice of market traits and is adaptive to them, since they're repeating over and over again. There might be more discoveries and new ways to combine them as we go forward in this evolution. What I find most useful is to directly use these two major constant players of speed changes and double moves together. To begin showing what that means, for this video I made a demo indicator that takes us back to our changing period setting value on an MA, but with a slightly different method for changing it. This is a 4-hour chart and it has a 100 period simple moving average. It's a bit different in that it is adjustable to 3-place precision, not just integer. The setting is controlled with a global variable as a speed multiplier. It's just multiplying 3-place period setting by 3-place value. I have it set now to 100 period, and that speed is first multiplied by 1.000, which displays on the chart as would any 100 period SMA. It also gives a readout of the effective combined time-price analysis. We referred to that earlier as the speed of analysis that's declared as soon as you add any indicator. Here it shows that with a speed multiplier of 1, this is the same as the 240 minutes in 4 hours. Using MT4's global variable control, I changed the speed to 0.125 or 1/8, and the MA changes to that value. What I set, the readout shows the effective speed of analysis as 30 minutes, which is 1/8 of 4 hours. That little splitting off of the period setting to a speed multiplier allows multiple indicators to be controlled with one change. Now the effect seen at this speed of analysis sort of duplicates the effect of the zigzag in showing off the traits of the double moves here and here. It also makes the MA show the speed of this move in a more relevant way, doesn't it? This serves to demonstrate the importance of the recognition of market constructs in formulating all TA methodologies. This simple display has no relation to a particular area, let alone serving all the requirements of a trading strategy. It simply shows there are ways to incorporate extremely important constant market characteristics of speed changes and double moves. Let's not repeat the mistake of simplistic TA's approach and underestimate the changeability and complexity of markets that has us looking together at TA's trouble. What I'm saying here is that when you observe the variations in speed and formations the market is capable of, it's immediately clear that one MA will not be able to do the job of both being a relevant as well as rigid comparative. The market would throw you off its back like a bronco if you are using a simplistic and amateurish approach. As you see, it doesn't need to be rocket science, but it can't be just throw your favorite TA setup on there. Respect the market. Know that every area is different. In fact, let me inform you that every new move chooses a new speed. It does not use just a few primary colors for its rainbow either. There's every shade imaginable in play. The speed of one move is related to the one that follows, just not the same. Where I can get a 30-minute analysis, I can also get a 22.5 minute or any speed required to match the market.